This is the story of how the world's most controlled bond market is losing control, and why that should terrify every investor on the planet. Japan's $7.5 trillion government bond market, the third largest in the world, is cracking under pressures that decades of manipulation can no longer contain. For nearly 8 years, the Bank of Japan owned this market completely. They capped 10-year yields at 1%, bought bonds by the trillions, and turned what should have been a free market into a central bank playground. But in March 2024, they blinked. They abandoned yield curve control, ended negative interest rates, and started raising rates for the first time since 2007. The result? A bond market rebellion that's sending shockwaves around the globe. The numbers tell a story of unprecedented market distortion. The Bank of Japan currently holds 522 trillion yen worth of government bonds. That's 50% of all Japanese government debt. In dollar terms, they own $4.1 trillion of Japan's $7.8 trillion total debt burden. No central bank in history has ever owned half of its government's bonds. This isn't monetary policy. It's financial engineering on a scale that makes the Federal Reserve's quantitative easing look conservative. And here's where it gets dangerous for everyone, not just Japan. Japanese investors are the largest foreign holders of U.S. Treasury securities, owning $1.2 trillion in American government debt. When Japanese bond yields rise, when their domestic market becomes attractive again, that capital doesn't stay put. It comes home. When $1.2 trillion starts moving, it doesn't move quietly. The cracks started showing in August 2024. The Bank of Japan surprised markets with a double-barreled shock. They raised interest rates and announced they were slashing bond purchases. The reaction was swift and brutal. Japan's Nikkei crashed 12.4% in a single day, the worst drop since 1987. The S&P 500 fell 3% on the same day. Global markets convulsed as what traders call the yen carry trade, borrowing cheap yen to buy higher-yielding assets worldwide, began unwinding. This wasn't just a Japanese problem anymore. For years, investors had been borrowing yen at near-zero rates to fund investments in everything from U.S. stocks to emerging market bonds. The size of this carry trade, estimates put it around $250 billion, but that's just what we can measure. The real number could be far larger. Stephen Innes from SPI Asset Management captured the moment perfectly. A massive global carry trade unwind was the spark that lit the fuse for this market Armageddon. One defining characteristic of these self-perpetuating market melts is the vicious cycle. When everyone rushes for the exit at once, prices collapse faster than anyone thought possible. But that August crash was just a warning shot. The real crisis is building now, in 2025 and 2026, as Japan faces what economists are calling a potential Liz Truss moment, named after the British Prime Minister whose unfunded tax cuts triggered a bond market revolt that destroyed her government in 49 days. The parallels are unsettling. Japan's debt-to-GDP ratio stands at 260%, worse than Greece at the height of the European debt crisis. Former Prime Minister Shigeru Ishiba wasn't exaggerating when he called Japan's fiscal situation worse than Greece. Greece's debt crisis began when its debt-to-GDP ratio was below 120%. Japan is more than double that level. The difference, until now, has been Japan's ability to fund itself domestically. While Greece owed 80% of its debt to foreign creditors, Japan has relied on its own citizens' legendary savings rate to buy government bonds. But that safety net is fraying. Japan's aging population is starting to spend down savings rather than accumulate them. The domestic bid for government bonds isn't guaranteed forever. The signs of stress are multiplying. In May 2025, Japan held a 20-year bond auction that saw the weakest demand since 2012. The bid-to-cover ratio, a measure of how many investors want to buy compared to what's being sold, fell to dangerous levels. When governments struggle to sell their debt, borrowing costs explode. By January 2026, the situation had deteriorated even more. Japan's 40-year bond yield hit a record 4.23%, while 10-year yields reached 2.38%, the highest level since 1999. These might sound like modest numbers to American investors used to higher rates, but in Japan's context, they represent a fundamental shift. The yield curve has steepened dramatically since the Bank of Japan abandoned control. Short-term rates have risen 56 basis points, but 40-year yields have surged 181 basis points. The human cost of this bond market stress is already visible in Japan's financial sector. The country's four largest life insurance companies, Nippon Life, Dai-ichi Life, Meiji Yasuda, and Sony Life, reported a combined $60 billion in unrealized losses on their domestic bond holdings. Nippon Life alone holds $25 billion in paper losses, 3 times the previous year's total. These aren't abstract numbers. These are the pension funds and insurance policies of millions of Japanese workers and retirees. When bond prices fall, the savings that were supposed to fund retirements vanish. The institutions that promise steady returns to policyholders suddenly face insolvency. Yuki Fukumoto, a senior researcher at NLI Research Institute, put it bluntly. The bond market is effectively the canary in the coal mine. When the canary stops singing, the miners need to evacuate. The political response has made things worse. New Prime Minister Sanae Takaichi, who took office in October 2025, has abandoned fiscal restraint entirely. Her Sana Economics stimulus package calls for 21.3 trillion in new spending, funded by, you guessed it, more government bonds. The new debt issuance is 1.7 times larger than under her predecessor. Financial markets are not impressed. Foreign investors, who now account for 65% of monthly bond trading in Japan, are demanding higher yields to hold Japanese government debt. When your biggest customers lose confidence, prices fall and borrowing costs rise. It's bond market economics 101. But the real danger lies in what happens next. Japan isn't just another country with a debt problem. It's the world's largest net creditor, with $3.66 trillion in overseas investments. When Japanese yields rise above global levels, that capital starts coming home. And that's exactly what's happening. The spread between U.S. 10-year Treasury yields and Japanese 10-year bonds has narrowed to about 2.1 percentage points. As this spread compresses even more, Japanese investors lose their incentive to hold foreign assets. Why take currency risk on U.S. Treasuries when you can get decent returns at home? This capital repatriation is already starting. From January to October 2025, Japanese investors bought 11.7 trillion yen in overseas debt, nearly 3 times the amount they purchased in all of 2024. But this buying spree is backward-looking. The real question is what happens when the flow reverses. Albert Edwards from Societe Generale sees the writing on the wall. Both the U.S. Treasury and equity markets are vulnerable, having been inflated by Japanese flows of funds. When those flows reverse, the air comes out of the balloon quickly. Ken Griffin, the head of Citadel, one of the world's largest hedge funds, called Japan's bond sell-off an explicit warning that the U.S. needs to get its fiscal house in order. When the smartest money in the room starts worrying about Japanese bond yields, everyone should pay attention. The global spillover effects are already visible. On the day Japan raised rates in December 2025, Germany's 30-year bond yield surged to 3.51%, the highest since July 2011. When Europe's fiscal anchor starts dragging, it signals broad-based stress in government bond markets worldwide. The Federal Reserve is watching this closely. Higher Japanese yields mean higher global borrowing costs, which could force the Fed to keep U.S. rates elevated longer than planned. It's monetary policy by contagion. What happens in Tokyo doesn't stay in Tokyo. Ed Yardeni, president of Yardeni Research, sees a fundamental shift occurring. The basic problem in the global bond market is this. Major governments of the major economies are living deficits. They've accumulated a great deal of debt, and investors are starting to demonstrate that they're not happy about that. For decades, investors bought government bonds, assuming central banks would keep yields low forever. That assumption is breaking down. In Japan, the United States, and Europe, bond investors are demanding compensation for the risk of holding government debt. That's a return to normalcy. But normalcy can be painful when you've been living in a fantasy. The Bank of Japan faces an impossible choice. They can raise rates to contain inflation and restore credibility, but that crashes the bond market and bankrupts the financial system. Or they can hold rates low and watch inflation destroy the purchasing power of Japanese savings while the yen collapses. Market expectations suggest they'll choose the first path. Traders are pricing in 2 more rate hikes, one in July 2025 and another in 2026, that would take the policy rate to 1%. That might not sound aggressive, but in Japan's leverage system, it's enough to cause massive disruption. Robin Brooks at the Brookings Institution argues that Japan is much closer to a debt crisis than people think. The difference between Japan and previous debt crises isn't the debt level, it's the speed of deterioration. When confidence breaks in bond markets, it breaks completely. The warning signs are multiplying faster than policymakers can respond. Failed auctions, rising yields, institutional losses, political instability, and capital flight. These are the ingredients of a full-blown crisis. Kit Jukas, chief foreign exchange strategist at Societe Generale, captured the stakes perfectly. You can't unwind the biggest carry trade the world has ever seen without breaking a few heads. The heads being broken aren't just in Tokyo. They're in pension funds in Ohio, banks in London, and investment firms in Hong Kong. The next few months will determine whether Japan can engineer a controlled adjustment, or whether markets force an uncontrolled collapse. The early signs aren't encouraging. Bond auctions are failing, yields are rising, and political leaders are choosing stimulus over restraint. This is bigger than Japan. This is about whether the global financial system can function when its largest creditor nation loses control of its bond market. The answer to that question will determine the investment landscape for years to come. When the world's most manipulated bond market finally breaks free, the question isn't whether there will be casualties, it's how many and how severe. The bond market has spoken. The only question now is whether anyone is listening.